Hey everyone! If you're looking for the best chance at success when it comes to investing, then you've come to the right place. There are three important things you need to understand in order to lower your chances of losing money in the stock market. Those three things are types of risk, investment types and their associated risk levels, and tried and true methods for reducing your exposure to risk. Buckle up because it's going to be a bumpy ride. My name is Josh, and welcome to Your Financiation. Let's jump right in. The first thing we're going to be talking about is identifying types of risk. More risk can mean more reward, but it's not always guaranteed. Risk can depend on many different factors, but it's up to you to decide how much risk you're willing to take on. Some risk comes standard with the stock market, but others you can be prepared for if you know the warning signs. So let's talk about 5 types of risk. Number 1, business risk. This type of risk is generally associated with stocks and bonds. If you own stocks, you're buying pieces of ownership in businesses. With corporate bonds, you're loaning money to businesses. There are a couple of things that could happen to a business that put those investments at risk. If a business experiences weak financial strength or worse, faces bankruptcy, you could be last in line when it comes to your share in the proceeds if the business assets are liquidated. There might be a lot of confusing words there, so let's break it down. A business performs poorly and files for bankruptcy. One of the options they may opt for is to sell all of the assets listed under that business to pay people they owe. The company's bondholders are paid first, then holders of preferred stock are paid. Regular investors like us typically hold common stock, and we're last in line. Sometimes at the end of the process, there's nothing left for us to receive except a bag full of worthless stock. That's where the term bag holder comes from, and you don't want to be a bag holder. Number 2, volatility risk. Volatility simply refers to the wild swings in the price action for a security, like stocks. If you remember hearing about GameStop back in January of 2021, that's a perfect example of extreme volatility. Volatility can be both exciting and scary to a beginning investor, because you can lose just as quickly as you can win, sometimes within minutes. Sometimes volatility can be unpredictable with individual stocks, so they're generally best avoided. When prices become more stable, that's a better potential opportunity. There are a number of factors that play into what might cause volatility in the overall stock market, and those factors can include economic or policy factors like changes in other markets, interest rate hikes, the Federal Reserve's current monetary policy, political instability, and global events like a pandemic or a war. That's a lot of information to stay current on in order to protect your investments. And in that sense, it can be unrealistic to stay on top of all that information. So later we'll talk about strategies you can use to reduce risk in simpler ways. Number 3, liquidity risk. This refers to how easy it is to convert your asset into cash. Some of the least liquid assets you can own include ones like real estate or art, because it can sometimes be difficult to find a buyer. When the demand for certain stocks drop, those particular stocks can be exposed to liquidity risk, and that can increase the potential volatility that those stocks experience. Number 4, inflation risk. I'm sure you've been hearing a lot over the past 9 months about inflation. If you're not familiar with what inflation is, it's the general upward movement of prices for goods and services. Where that more than likely hurts you is at the grocery store. There's a percentage rate associated with inflation, and you can do a quick Google search for what that is by searching current rate of inflation. At the time of this video, the inflation rate is at 6.5%. If you are investing in anything not providing greater than a 6.5% return, you're exposed to inflation risk. Number 5, interest rate risk. The Federal Reserve has the power to increase something that's known as the federal funds rate. According to Investopedia, the federal funds rate is one of the most important interest rates in the US economy, and that's because it affects monetary and financial conditions, which in turn have a bearing on critical aspects of the broader economy, including employment, growth, and inflation. Now, according to Forbes, a higher Fed funds rate means more expensive borrowing costs, which can reduce demand among banks and other financial institutions to borrow money. The banks pass on these higher borrowing costs by raising the rates they charge for consumer loans. With regard to how this can affect you as an investor, an increase in interest rates could affect the value of bonds. They have an inverse or opposite relationship to each other. So when interest rates go up, bonds go down. If your portfolio is bond heavy, you could be at interest rate risk. The second main topic I want to talk about in this video is investment types and their associated risk levels. Risk is generally evaluated by looking at the historical performances of whatever particular investment you're looking at. Let's go over several investment types and their associated risk levels in what I like to call a quick stats format. Stocks. A stock is the general term associated with buying shares or pieces of ownership in a company. Stocks can provide potential for appreciation or an increase in value of the shares you purchase over time. Stocks also have the potential for dividends, which is the company's way of sharing profits with its investors. Risk varies, and I'll cover this in the strategies for reducing risk portion of the video. Bonds. Bonds are basically an IOU with interest. The risk level depends on the type of bond. Now, the IOU is issued by a government, municipality, or corporation. Bonds from the government are typically low risk. Bonds from corporations can come with higher risk. Bond types will be covered in a future video in more detail. Options. Options are contracts that gives the person who buys them the right to buy or sell the underlying asset at a set price. The right to buy is also known as call options, and the right to sell is known as put options. These are very high risk, but have a great potential for high return. Options are one of the more complex investment types, and it's best to consult with a financial professional. Mutual funds. A mutual fund is pooled money from various investors that invest in a basket of assets, like stocks, bonds, and other securities. The goal of a mutual fund is to outperform the market. Mutual funds can be actively managed by a fund manager who typically works for the broker you're investing with. Risk varies depending on the investments the fund manager selects. Index funds. Index funds are similar to mutual funds. They're a basket of assets, various stocks and bonds, but index funds typically seek market average returns by mimicking a market index, like the S&P 500. They're passive and offer great diversification, low risk, and typically low cost. ETFs. ETFs are similar to mutual funds. They're a basket of assets. Unlike mutual funds, ETFs are represented in shares and traded on an exchange at a fluctuating market price. The risk varies depending on the goal for each individual ETF. Single stock or inverse tracking ETFs are highly risky. Annuities. Annuities are contracts between you and an insurance company, typically purchased in retirement to help manage income. There are three basic types of annuities: fixed, variable, and indexed. They're a form of ensuring retirement and way of receiving periodic payments. Commodities. The most commonly traded commodities include oil, gas, foods, and metals. Direct investments in commodities and commodity futures is typically done by corporations involved in a particular commodity. It is more common to add commodities as a way to diversify through mutual funds or ETFs. Retirement plans. These are plans that will help you save for retirement. There are multiple types of retirement plans and types within types. IRAs can come in the form of traditional, Roth, SEP, and simple. 401k also come in traditional and Roth, typically employer-sponsored. They usually offer choices for you to select which type of funds you can invest in. And a 403b are schools, nonprofits, churches, and 457b is state and local government. I'll cover these in more detail in a future video. Cryptocurrency. Cryptocurrency was an increasingly popular form of investment, but has somewhat fallen off since the decline in cryptocurrencies like Bitcoin and Ethereum more recently. They're a relatively new form of investing, and there have been a lot of cases of fraud surrounding them. They come with extremely high volatility, and it's seen as extremely risky, but can have potential for high returns. CDs. CDs are considered more of a savings account than anything else, but they hold a certain amount of money for a specific period of time. Could be anywhere from 6 months to a year or 5 years. They're low risk, considered safe, but generally have a low return. The third main point I want to talk about in this video are tried and true methods for reducing your exposure to risk. Number one is time in the markets. A common phrase you'll hear when it comes to investing is to focus on time in the markets and not timing the markets. Benefits to long-term investing include higher earning potential, reduced taxes, and of course, reduced risk. The second strategy is asset allocation. This is a form of diversification, and it involves investing in different asset classes like stocks, bonds, real estate, and gold, just to name a few, in order to reduce risk. By spreading your money out across the different asset classes, you're less exposed to one particular asset class declining in value or suddenly seeing a change in its performance in the overall market than you would be if you were to just focus in on one. And the third thing is diversification. Diversification is more about spreading the amount you invest within one asset class. For example, if you're investing in stocks, diversifying would mean spreading the amount you invest across multiple companies in different sectors. And the easiest way to do this is with index or mutual funds. And that just about does it. Now I will be going into a little bit more detail with some of the topics that I covered in this video in future videos, so be on the lookout for those. If you're still here, I appreciate you being here, and until next time, thanks. With regard to how this could affect you as an investor, with an increase in